Welcome to Behind the Doors, the podcast where we take you behind the scenes of residential real estate investing. I'm your host, Dan Noma Jr., here with my co-host, Marvin Cruz.
We're here to help you unlock the best strategies and practice for investors. Whether you're just starting out or you're a seasoned pro looking to scale your portfolio.
We've spent decades navigating the ever-changing world of real estate, and now we're sharing everything we've learned to help you succeed.
From off-market deals to cash flow management and everything in between, we'll break it down and bring you actionable insights that can make a real difference in your investments.
So get ready to open the door to new opportunities and take your real estate investing to the next level. Let's dive in.
Hey, happy holidays. Happy Thanksgiving.
Happy Thanksgiving to you, man.
Yeah, appreciate you. Before we get into today's topic, though, what are you most thankful for? Like when we sit around our table for Thanksgiving, we make everybody go around and say, what am I thankful for? What about you? What are you most thankful for this particular year?
I think, I almost hate to be too cliche, but the family is always, to me, something to be super thankful for. My kids and my wife right now are like, my kids are at an age where we're just having like so much fun. They're becoming humans. They're 8. They're like, like today, my son and my daughter rode their bike to school, and I'm still following them in the truck. I'm just following along, but it's just like, I don't know, we're having so many of these like big life moments right now that it's been a ball. And
That's
so
awesome.
like all the chaos of our crazy 2024 election, this and that, it's like, at least I know I got all that to come home to, and I'm super thankful for that.
No, that's awesome. We talk a lot about experiences, creating experiences is what we say. We try not to say no. Like the kids want to do this, let's do it. Let's just try it, right? So I'm so thankful for my family as well that we are experiencing all these new things, being in Arizona again and traveling more, and it's just been creating fun. So, and by the way, I'm thankful for you, buddy. I'm so thankful for you and what you've done with Easy Street.
Man.
The knowledge that you are providing this platform, I think people are going to get a lot out of it. And by the way, you're giving it away as for free, right? We're not charging subscription. It's time to give back.
It's time.
And, speaking of giving back, I want to talk to you about one of the most popular strategies that is out there that helps people scale their real estate portfolio, which is the BRRRR method, right?
BRRRR.
So BRRRR, B, buy, you rehab,
Right.
you rent it out,
Yep.
you refinance it, and guess what? You do it all over again and you repeat that.
Yep.
So let's talk a little bit about that. I want to go step by step for the audience, though, because I really want them to take home today this BRRRR method.
Yeah.
So let's start with the buy. And if I miss anything on what BRRRR is, please chime in. But
Before we get into that,
please.
one more thing. Can we talk about what happened last night real quick?
I do not want to talk about what happened
Why
last
not?
night. Definitely do not want to talk about.
Can we talk about your half-court shot
So for
attempt?
those, what Dan is referring to is I had an opportunity to shoot a half-court shot at a halftime game in Footprint Arena.
Yeah.
And it did not go well. But I will say, I think they kind of iced me a little bit. I got up there, and then they told me to sit back down. And then, I don't know, my arms got really weak.
I know.
But
It
it wasn't just short. It was short and
right.
And right.
Yeah.
Like by a long shot.
And 30, 30,000 of your closest friends saw it.
I think one guy asked me, were you trying to hit the Jumbotron? I was like, that wasn't the game.
I feel like
but anyhow.
we couldn't even talk about BRRRRs until we covered. I got to get it. I just had to get it off my chest. Everybody needs to know. We just have to get it
I was
out.
really hoping you got past that today. All right. Anyhow, it's not about my jump shot. By the way, I used to make that all the time.
I know.
But anyhow,
I know.
This is about investing. One of the most popular strategies out there, the BRRRR. So again, you buy, you rehab, you rent, you refinance, and then you repeat it. It's ultimately designed to help investors become more scalable with their real estate portfolio, right?
Yeah.
All while minimizing their upfront capital.
Totally.
So,
The beauty of the BRRRR, like the premise is amazing, right? Like you can buy real estate, you can build a portfolio of real estate with the same amount of invested capital. So if you started your first real estate venture with, let's say you had like $150,000, you could build a portfolio of hundreds of homes with that same $150,000. You don't need additional money to do this. And that's why I think a lot of people get into it. And there's ways to stumble in it too,
Correct.
you know, and I think we'll cover some of that, but it's a great way to build a nice rental portfolio and just cash flow some assets. You know, I think like the downside of it, and we'll cover some of this later on, is just that it might take you longer to pay off some of these assets. Like your equity position isn't as strong. And there's like schools of thought across all different channels of that, you know, whether that's good, bad, or indifferent. That's for, you know, everybody to decide. That's their own thing, you know, but I think let's just get into the strategy and talk about it.
All right, let's start with step one, right?
Yeah.
The goal here is to purchase properties below market value. That is the goal.
Yeah.
Talk to the audience about what are some of those key criterias, and they'd even allude to some of the financial options that they may have out there.
Yeah. So I think, you know, when you're looking for the buy of this, it all starts with this, right? Like as any real estate investment starts, it starts with the buy. The buy is like the most critical thing that you can do. And especially in the BRRRR, like it's so critical because you're buying a property that's under market value. Right. So if the current market value of the property is $150,000 and you can buy it because the property's in distress, and typically that stress shows up in like physical form, but sometimes, as we were talking about earlier today, it shows up in like it can be subjective or financial. It can be, you know, I got to move because, you know, my daughter's having a baby.
Right.
Those things, consider that distress as well. When we're talking about distressed properties. So it could be physical or the latter. But typically you see it when properties need a repair, right? So property needs a repair and it's in a strong rental market area. So you know that you're going to get it rented because that's a big key to this thing is you got to get it rented. And when you renovate the asset, it becomes more valuable after you renovate it. You know, a lot of investors will talk about after rehab value, after renovation value. That's super critical in the BRRRR because you know, if you buy a house for $100,000, it costs you $10,000 to renovate it. Is it worth $120,000 now, or is it worth $110,000? You gotta kind of know what that's going to be, you know. And so, a lot of times, a good way to think about this is like when you know, like let's say you're laying tile in a house or you're painting a house or you're putting new countertops in the house. There's always this rule of thumb where, you know, you could say that, you know, when I put those assets in the property or I spend them, there's a retail cost of those. Like that's how much it costs me to put in. But then it has a retail value on the other side. And the value is what we're talking about. So like, what is that tile installation of that tile worth in property value terms versus like what was the hard cost to put it in? Does that make sense?
Totally.
Okay. And you know, I think that, you know, with the BRRRR, typically the someone doing a BRRRR, thinking about a BRRRR, they're either buying the property all cash, right? And then they've got the money for the renovation, or they're using short-term financing to get the property. Typically banks aren't lending on properties that need a lot of work, you know. So if a property is missing doors and windows and, you know, there's a ton of distress, banks aren't lending on those. You're not going to get traditional financing on that type of deal, but there's hundreds of short-term options out there for capital to where, you know, and these capital partners, typically they're really flexible and they offer on terms. So they offer based on the asset. So lending is all based on the asset. So if you're one that is interested in this, you know, the key would be to like get with Marvin, understand a little bit about like, you know, what our financing options could be, because you can get into a rental situation for as little as like 20% down. So 20% down, you could start your rental portfolio using this methodology.
All right.
You know?
Yeah. Got it. So buying, right? We're looking for properties that are distressed. Doesn't have to be physically distressed, but typically it is.
You got to buy it under market value.
You got to buy it under market value.
Yep.
You also have to have it in a rental demand area, right? You don't want to just rehab something that no one's going to rent out, right? That's awesome. All right, let's talk about this rehab for a moment. So rehabbing, obviously the idea it's to increase the value of the property. But you got to be smart about this rehab, right? Like a lot of people, you know, I know just from my experiences, the kitchen is the first thing and probably the most important.
Yeah.
But what else should folks consider, or what else should they focus on as it relates to the rehab portion of it?
Yeah, I mean, what you're trying to do here is you're trying to improve the property's value,
Yeah.
right? And so some of the things that you really should think about, like you said, kitchen, bathrooms, floorings, the curb appeal about that property is super important. But it's like what's behind the walls too becomes really important. So like the plumbing, the electrical, the roofing, all of that stuff. Not only because in the BRRRR, the reason it's even more critical in the BRRRR is that it's not just about the appraisal when you refinance it, which we'll talk about next.
Yep.
It's also like the tenant that you're moving into that asset has got to want to pay market rent for that property, right? So it's got to make sure that that property is marketable.
Yep. Yep.
So, what I would say to people on the BRRRR is like, don't go crazy, right? But start with looking at comparable properties that rented for a value that you're going to try to shoot for, right? So if in a neighborhood there's comparable properties that were renting for $2,500, go look at those $2,500 properties. Like look at the photos of those properties to make sure that when you renovate, your property looks like those. And if it does, you're likely to find a tenant that'll do that same thing, and pay that same amount for it. So the renovation becomes key. It can blow a BRRRR. Like the renovation could blow a BRRRR if you over renovate it or under renovate it. So it's kind of critical that you do it with a lot of logic, and you're doing it in a way that you have the future in mind, right? So it's not like a flip where you're going into the flip and you're renovating the asset completely, top down to get absolute top dollar for it. You can in a BRRRR, but is it going to rent for more if you do that, or is it just rent for that $2,500? So you've got to make sure that you're conscious of not only the future value of it, but the rental value of it as you're renovating the asset.
Yeah, for me and probably a lot of folks listening, the scary part is the rehab. One, from the budgeting perspective.
Yeah.
Because it's one to get it to look a certain way, but then there's the behind the walls, as you always say. Part of it is getting it up to code.
Yeah.
There's something, once you tear that wall down, you don't know what's behind there. And so you definitely got to budget accordingly is where I'm going with that. So, what are things people can do from a contractor perspective? Are there things that you consider there when you're budgeting as well? Because not only do I need to get it to look like this, I got to pay someone to do that as well, right?
Yeah, I mean, I would never tell anybody to not use a licensed contractor, and I think like I fortunately, unfortunately, call it what you will. I grew up with one, right? So like for me, I was always taught that, a property you had to use a licensed contractor on everything. That licensed contractor assumes a lot of liability and they have to guarantee or warranty their work. So that had some value to it. I do see a lot of people that will renovate a property, and do it themselves, right? Just kind of a do-it-yourselfer, and they do it, and they maybe they do a great job. Sometimes they don't, and that affects the value of an asset. Like it's always like a premium, I think, when you can say that the property was renovated by a licensed contractor. I think it adds some value. Whether that's, on paper or that's like in the mind of the tenant that's choosing between two assets. If I was going to move my family in a place, I would, be sure that the electrical was done by somebody that was, licensed. So I think it adds value, but I think it's got to be one of those things where you got to budget it out when you're at the buy side, and you got to look at the budget and walk it with whoever's going to do the renovation with you, and make sure that you have checked everything, because if you don't and you blow the budget, you blow your BRRRR, right? And you're not going to be able to do what you wanted to do. So it's key to have the future in mind with all that.
No, I appreciate it. All right, we bought the right home.
Yep.
We now renovate it.
Yep.
Now we got to secure a tenant in this place. That is another fearful thing, right? Because you want to make sure you have a quality tenant that doesn't just tear down what you just built, but more importantly, pay rent and pay on time, right?
Pay on time, yeah.
So what steps should folks take to ensure that they secure the right tenant?
Yeah. I think, where I think it starts is the price, and I think gets overlooked. Like too many people get caught up in the application. And I'm like, where you start with the right tenant is by starting with the right price, right? If you price a rental property appropriately, you're likely to get a few tenants, that you can now start to choose from.
Okay.
If you shoot for the moon, right, on your rental price, and there's only one person that's willing to stretch up there, every time I stretch on one of those situations, I've always been burned a little bit
And when
by
you say
like,
stretch, are you saying high rent or low
yeah,
rent stretch? High rent. Okay.
high
Okay.
rent
So
stretch,
you want more
Yeah, let's
to
say you're
increase
getting
your
a little
yield,
greedy,
but
right? And
yep.
the comps in the neighborhood say, okay, it's going to rent for 2,500, and you go, I'm going to push it at 3,000 because I just think my property's better, right? It's just a subjective idea that I think I'm going to get this. The problem ends up happening, right? Is your tenant's also doing that too, right? Because they're moving into an area that they can afford 2,500, but if they stretch, they could maybe afford 3,000, right? And now you're kind of putting the tenant in a situation where this is why when lenders look at like debt to income ratios, they're trying to figure out like what's going on. You kind of put the tenant in a situation where they now are stretching,
Yep.
right? And if something happens to the property in a property where I'm at market rent, my tenant typically has got a couple bucks. Like they could call the plumber, they could like fix little things, do it without calling me. If I've stretched on rent and I'm at the top, my tenant's stretched too financially. I might get a situation where like they're calling me all the time every time something breaks. Like I've just seen it happen enough to where I would say like, if you're going to do a BRRRR, be consistent. Just hit the market. You don't need to push the value. Just hit the market value.
Yep.
Hit the market value for rent, and I think you'll be in a much better place.
Yep. What about, we all have a friend that needs a place to stay.
Yeah.
Would you ever do that without a contract?
Oh my God, no. No.
Why not? Tell us why. Why would you
no,
not? Why would you let me
no.
stay there and I'll pay you? I'll pay you, Dan. Don't worry, I'll
Well,
pay you.
maybe you, but tenants, I think that, there's we should do a whole episode on tenants because I think there's a whole thing on that.
Good idea.
But tenants, a good way to like vet a tenant is one, to ensure they're not your friend. Right. Like, I mean, because there's too many handshake deals out there. Right. And like the world is not certain, as you and I both know.
Yeah, that's
right.
true,
Like
very
every
true.
day I'm met with a surprise. I know you are too,
Yep.
where I'm like, how did that even happen? What is that? That is just the most
head
strange
scratcher.
thing. So somebody that looks amazing as a friend comes in, they got a great job, they go into work next week, they get nixed, and now you've got a friend living in your place
Yep.
that can't afford to pay the rent, and you're having to subsidize rent. That's a struggle, So I've always found like better just to not rent to, families, friends, stuff like that. Like it's a business, run it like a business. If they qualify and they check all the boxes, okay, like that's a different story, right? But if I'm just going to let them in just because they're a friend, like that's not it.
No, I love that.
But I think you really got to screen those tenants, right? Thoroughly. A good property manager helps with this a ton. They've got software that does this really well, and they've got like grading rubrics where they can give you the risk profile of any tenant, and it's all based on like their credit, their background checks, their income verification, their rental history. All of those things like play a factor into it, and then it becomes ultimately your decision. Where you got to go, okay, am I gonna, maybe this person has really poor credit, but they had a divorce or a bankruptcy in the past or something.
Yep.
And now they got a new job and they've been at this for 2 years and they're doing this and their rental history is great and all this. Like, I'm okay looking at that. You know what I mean? Like, I think everybody deserves a chance. So I think it's very subjective. But using a legal lease is critical, because when the sky turns purple and you got to move that tenant out, or they don't quit paying rent, or there's something, you got to have something, So a key there is huge. And quite frankly, in the BRRRR method, you're going to need it to refinance. Anyways. So you got to do it. You got to do it this way.
Oh, that's a great point. And you got to remember why you got into this in the beginning, right? You got a tenant in there to cover your expenses that you just put into this home, right? And by the way, that's a perfect transition. It helps with refinancing, having a quality tenant in there. And so let's talk about the next R. So now we purchased the right property. we rehabbed, we rented it out, we got a quality tenant.
Yep.
And now we want to do some things with the money. So we want to refinance. And refinance is going to allow us to basically pull that equity out of the property and use it for other things. So tell everybody about the refinancing part of BRRRR.
Yeah. So I think the best way to like explain this would be, to give you like numbers.
Yep.
And, so let's say for example, the refinance process, I guess starts when the property's stabilized. And stabilized, the term isn't just like the property's rent ready. It means that the property's occupied by the new tenant and there's a lease in place. Right. That's when the bank will consider that the property's stabilized. Right. That means that now it's stabilized. Let's say you buy the property for, $100,000. The renovation costs are $30,000.
Yep.
That makes your all-in cost basis at $130,000, right? That's your cost.
Yep.
Okay. That property, because of our, like, remember we talked earlier about like the renovations adding to the value?
Yep.
Well, the tenant also adds to the value, right? Because now you've made a property from like a traditional, just this is what the property's worth, to an income producing property, right? So lenders look at income producing properties differently than they look at just a traditional house that somebody's living in and just staying in. So an income producing property gets treated differently on an appraisal. It gets treated differently kind of across the board. So it's key that you stabilize it with a tenant. So it's stabilized with a tenant now. And let's say that after rehab value of the property is $200,000. You can refinance, typically you can refinance up to, I've seen some cases where they'll let you refinance up to 80% of that future value. So that $200,000 value, they'll let you refinance up to that number. But let's say they only let you refinance up to 70%, which is probably more baseline.
Yep.
Then now you're going to get back 140,000 of your initial investment. So you had 130 into the deal. That was your hard cost.
Yep.
You refinanced it at 70% of 200,000. That's $140,000 that you're going to cash out from the bank, right? Because the bank is going to hold 30% of the equity, right? And then they're going to finance that 140. So now your tenant's making your monthly mortgage payment on the 140 on the on the money that you borrowed, the 140,000, and you're making a mortgage payment now with the tenant's making your mortgage payment, and you got all of your risk out of the deal. You got all of your cash back out of the deal, and you just go and do it again.
Do it again.
You know what I mean? Is that
totally
are you tracking
makes sense.
on that?
Absolutely. Yeah,
I'm not
totally
sure if
makes
that's
sense.
the easiest way to explain the refinance part of it, but it's, you're going from like, even if you did it in short-term money, so like average short-term money rates somewhere between 10 and 15% today. I've seen them as high as 18, right? So like that's a range in short-term money because you're only holding it for a short period of time. I think we've talked about hard money and all of that stuff once before, but so let's say you're going from a hard money loan into a conventional mortgage, or like in this case, it would be more of like they call it a DSCR loan. So it's debt coverage ratio is how they're building it.
Right.
That, like the interest rates on those two on a stabilized asset is significantly different. You're going to get a market rent. You're going to get a market rate on your refinance, so you're not refinancing the property at 10, 12%. You're refinancing the property at market rent. Today it's like 7, maybe on an investment property, it's a little bit higher. But let's say that comes down. Now you can refinance the asset too, if you want to as well.
Well, maybe elaborate there, because maybe that's where some of the audience is like, okay, I got a quality tenant. They're covering. Why refi though? What are the benefits of the refinancing portion?
The only time I would tell an investor to refi one of their rental properties is if they're going to use the cash to reinvest.
Got it. There it is. There it is.
That's the repeat part.
So there's the repeat.
That's the
beautiful
repeat
transition, by the way.
Amazing. Really, this is a brilliant way to buy real estate, isn't it?
Exactly. Yeah. All right, let's talk about that. So now we're going to do it again.
Right.
All right. Tell it why. What are the advantages of doing this again?
Well, you got to keep in mind now. So so if we go back to our scenario, if I now got back my original 130,000, I actually made $10,000 on this transaction. and I have zero out-of-pocket expense. Zero of my cash is still into this deal.
Yeah.
Yet I own it,
Yep.
right? And the tenant's paying my mortgage payment. Maybe I'm cash flowing a little bit. I might be making $100, $200 a month on the rent above and beyond my expenses of the house. Like that's great. And if you put a 15 or 30-year mortgage on it, just keep it, because in 30 years, 15 years, whatever you put on there, the tenants over time have paid for your property.
You're winning.
You got the house for free.
You're winning.
Like that answers your question on why repeat is because if you can build a portfolio of rental properties, and let's say, for example, you were to do this strategy for 5 years, right? You just did BRRRRs only for 5 years. That's all you did.
Yep.
All you need to start is like in this scenario, you needed $130,000 to start. And really what you needed was 20% of 130,000, because hard money people will lend you the other part if you wanted that, right? So really, you didn't even need that. You needed like $35,000 to get started. And you can build a rental portfolio with that, because you can just rent, do that same thing again. Buy it, renovate it, rent it, refinance it, cash your money out, use that same cash into the next deal, pull the cash out again, do it again on the next deal, pull the cash out again, do it on the next deal. The next thing you know, you've got a portfolio. And like I've seen people do this where they get 10, 15, 20 properties pretty quickly that they've aggregated. I mean, it doesn't, like what we're talking about, doesn't take a huge amount of time. It can be done 90 days. You could be in and out of one of these, pretty quickly. And you could do, just repeat that every 90 days until you've got 6, 7, 8 rental properties, right? Over a 5-year period. And now the tenants are paying your mortgage payment. You own the real estate. So you own the appreciation of the asset and you own the cash flow that it's getting. And it doesn't cost you anything. There's risk, right? The tenant could not pay rent. You might go vacant a couple months. Like those things are still going to happen, but you got to build a portfolio with like the lowest amount of risk possible. Which is
I love it.
amazing.
So many advantages to the BRRRR method, right? It's scalable. There's tax benefits as well. And then obviously you're building wealth, right? At the end of the day, you're building wealth.
Huge.
Any other challenges or risk associated with the BRRRR method? Because, obviously high risk, high reward when you're doing flippings. So let's just be upfront and honest about what are some of the challenges and risks with this method?
I think we covered a bunch, right? But I think the renovation costs, if they go out of budget, that can be an issue. If the property doesn't refinance at the value you thought it would, like say like you're in the middle of renovation and the property values in the neighborhood start to go down. That can be a challenge, right? That's gonna disrupt your ability to go. Tenants, right? So like we said, tenants may not pay rent, or they might, you might have a tenant move out. It might take you 2 or 3 months to find your next tenant. Like during those periods of times, those dark vacancy years, like that's obviously a challenge. And then, with the lenders, like if you're going to start a BRRRR, start with your end lender. That's where I would always tell somebody to start, is go meet with a mortgage advisor that understands cash out refinances on investment properties.
Right.
If they don't, like that's the phrase. If they haven't done a cash out refinance on an investment property and don't have a product for it, that's not your lender. Like you got to find somebody that knows how to do this, because they're going to be able to set up the appraisal appropriately. They're going to be able to set your file up appropriately. Like all of those things are super critical. So I think those are kind of the 4 big risks as you're thinking about it.
I love that. Thank you so much. I'm excited for the BRRRR method. And I just want to remind and close with this on the BRRRR method. It all starts with the buying. And you want to buy the right property. So use data behind that decision. That's where we really come into play. That's what you helped start, is a company that helps folks find the right property with data. But anything else you want to close out with there? You definitely need the right tools.
No, man. I think that, it is the year starting to close out, right? And you're starting to think about your next year plans, 2025. Like, I don't know about you guys, like Linz and I like to sit down and come up with our strategic plan for the following year.
Yeah, mine was always lose weight, by the way.
Always.
Yeah, I'm that guy. New
Yeah.
Year's resolution, I'm in the gym.
But
But keep going.
financially, we'll set a goal, and sometimes we hit them, sometimes
Yeah.
we don't,
Yeah.
but like we try to like put money away and make sure that we're building like a future and stuff like that. I think if you're out there and you're like listening and you're going, all right, I want to get into real estate investing. I've got a small amount of money, and you've heard us talk about like syndicating. And I know last week you were talking about, self-directed IRAs and all of this stuff. It's like, okay, great. All that's amazing. But like, no, you can get started with 30,000, like 20,000, 20% of whatever the value of homes that you're considering. You can start with that.
Wow.
And you could build a rental empire as a result. People have done it. It's not like it's a new thing. This is like proven. There's no gimmick here, and that's what I love about it. There's not like, we're not pitching a gimmick. This is real life. This is how people have gotten wealthy for years. It's just down to a simple form, so you can digest it.
Thanks for tuning in to another episode of Behind the Doors. We hope you found today's insights valuable for your real estate investing journey.
Remember, real estate success doesn't happen overnight, but with the right tools and strategies, you can build long-term wealth and create passive income.
If you enjoyed the show, be sure to subscribe, leave us a review, and share it with others who are passionate about real estate investing.
Don't forget to follow us on social media for more tips and exclusive content.
Until next time, keep unlocking new opportunities, and we'll see you on the next episode of Behind the Doors.